With a look at the housing trade, the home construction ETF, the ITB, it is tracking for its worst month since 2020. Our Diana Olick joins us now with a look at what's ahead for that space in 2025. Diana.
Well, Frank, we're going to start 2025 on a mixed footing in the housing market. Let's start with mortgage rates. After a pretty volatile year, we're back at the highs with the 30-year fixed well over 7%. Expectations last year were that rates now would be in the low sixes, heading toward a 5 handle. That is no longer the prediction. As a result, the home construction ETF, ITB, is down close to 17% month to date, on pace for its worst month since March 2020, which, of course, was the very start of the pandemic. Now, builders have been buying down mortgage rates, but it's really hitting their margins. One outliner, though, Toll Brothers, the luxury home builder, it's down for the month, but still way up year to date. Its high-end buyers are, of course, less dependent on mortgage rates. All that said, on the existing home side, we just got the read on pending home sales in November, up 2.2% month to month and up 6.9% from November of last year. That's the fourth straight month of gains. Now, the count is based on signed contracts, so it's people out shopping in November when the average rate on the 30-year fixed spent much of the month over 7% before coming down in the last week of the month. NAR's chief economist Lawrence Yun said in the release that consumers appeared to have recalibrated expectations regarding mortgage rates and are taking advantage of more available inventory. The one problem, though, Frank, is that home prices are still gaining.
Certainly, mortgage rates above 7%. Who would have thought that? Diana Olick, thank you very much. Rob, coming over to you. You own two stocks related to the housing market, Lowe's and Home Depot.
Yes, and this has really been of late ground zero for rates doing what no one expected them to do, which is to continue to climb and climb at a pace that was pretty significant. These continue to be high quality businesses. We've owned them for quite some time. It is a small part of our portfolio, but they have healthy profitability, great capital efficiency. They're going to be beneficiaries if rates start to come down. But, you know, that's a requirement for this sector. So I think it's going to be a bit, but we're being patient with the names.
Jason, coming over to you. You own D.R. Horton. I'm just looking at the earnings. I mean, selling prices have been flat for the last couple of quarters. Look at a lot of these home builders raising incentives as we've gone on quarter to quarter. I mean, it doesn't seem like it's a really great business right now, even with the shortage of about 4 million homes in the U.S.
There's no doubt about it. Obviously, DHI has suffered this year. It's down 7% year to date. This is a completely affordability issue. As you see 30-year mortgage rates above 7%, we're going to need those names to drift lower. And we know that the 10-year is a proxy for mortgage rates. And when you have a 10-year floating above 4.5%, it's going to be tough for those numbers to come down on the interest rate level. So for me, obviously, that's where DHI plays. You know, 69% of their homes that were delivered over the last year are lower than $400,000. But when you have mortgage rates at 7%, it's a tough hill to climb, and that's why they're struggling.
Look, I agree with what Rob said about the potential positive catalyst, but you have to acknowledge that they were in a great place, the home builders, in 23 coming into 24. 24, they're in a very difficult place, broken momentum, and 13% of the home building construction industry is undocumented workers. With the conversation surrounding immigration going to intensify in the new year, that's a challenge for labor costs.
Yeah, a lot of people have cited that as potentially raising the prices of homes because of a potential labor shortage in home building and the housing market overall. So certainly something to think about with that new administration.